Hello, everybody. Welcome. Let's get started right away. Tesla stock is up 0.6% at $284 per share. S&P 500 is up 1%. Dow Jones up 0.5%. NASDAQ up 2%. Gold is down 3% today. Some volatility going on in the markets. NVIDIA is keeping the markets higher. NASDAQ and S&P 500, majority of the or a large chunk of the outperformance today or increase today is due to NVIDIA and all as well as Microsoft up 8% and Meta up 4%. Qualcomm, on the other hand, is down 8.5%. Healthcare stocks are struggling today. Eli Lilly down 11%. The entire healthcare sector is down. Financials are mixed. Utilities are up. Okay, let's dig into our article of the day. Wall Street leaps to 1 month highs as Microsoft Meta surge. Wall Street's main indices jumped to around 1 month highs on Thursday, with the tech heavy NASDAQ leading gains as long as strong quarterly results from heavyweights Microsoft and Meta pointed to a resilient outlook for the technology sector. Microsoft surged 9% to its highest level since late January, driven by an upbeat quarterly growth forecast for its cloud computing business, Azure. The jump helped the stock surpass Apple to become the world's most valuable company. Meta gained 5.6% after posting higher than expected revenue on the back of a strong advertising performance. The ongoing tech earnings represent a critical inflection point for the market, said Joe Tigay, portfolio manager of Rational Equity Armor Fund. Microsoft, Amazon, and their peers aren't just reporting numbers, they're revealing whether businesses are doubling down on cloud and IT or pulling back amid trade wars and economic uncertainty. The fallout from erratic shifts in US trade policy has been the dominant theme this earnings season, with many companies slashing or withdrawing their profit outlooks. Still, the S&P 500 first quarter earnings are seen growing 12.9% on an annual basis per LSEG data. That's pretty strong. Double-digit earnings growth year over year in the first quarter is really strong. Results from mega caps, Amazon and Apple, are due after market close. Amazon shares were up 3%. Apple shares were little changed, lagging the rest of the Magnificent Seven stocks after a federal judge ruled the iPhone maker had violated a U.S. court order to reform its App Store. The S&P 500 and Dow were at nearly 1 month highs, while the Nasdaq jumped to its highest since March 28. The S&P 500 is headed for an 8-session winning streak, its best since August, if gains hold. Other technology mega caps also rose, with Nvidia up 5%. That lifted the IT sector and communication services 3%, 2% respectively to over 1 month highs. Weekly jobless claims coming in ahead of Friday's crucial non-farm payrolls data showed layoffs increased more than expected last week, potentially hinting at a pickup in jobs cuts following tariffs. ISM PMI data showed US manufacturing contracted further in April, though slightly less than expected by economists polled by Reuters. That followed Wednesday's data showing US economy contracted for the first time in 3 years in the last quarter. Among other earnings, Eli Lilly lost 11% after its quarterly results, pressuring healthcare sector, while McDonald's dipped 1% after posting a surprise drop in first quarter global sales. We're going to dig into that. Mobile chip designer Qualcomm fell 8% after forecasted hit revenue from the trade war. We're going to dig into that too. GM gained 1% after offering a new forecast for 2025 core profit. We're going to look into that as well. Advanced issues outnumbered decliners by 2 to 1. Okay. Any questions, comments, please request to speak. Let's go on to um, tariffs squeeze US manufacturing in April, lift input prices. So this is stagflationary report, yet another data point by ISM manufacturing that point to stagflation. Tying the Fed's hands next week. The probability of rate cut dropped sharply this morning after this report, from about 8-9% to now about 4-5%. So I think the market agrees at this point that we're not going to get a rate cut next week. But I suspect what they may be surprised about is whether we're going to get a rate cut in June. Um, Obviously, it's too early to tell. It's on the May 1. The June meeting is towards the end of June, second half of June. And but I'm sure Powell will, talk about it at the press conference on Wednesday. U.S. manufacturing contracted for a second straight month in April as tariffs on imported goods strained supply chains, keeping prices at the factory gate elevated and encouraging some firms to lay off workers. The ISM survey on Thursday showed President Trump's protectionist trade policy was hurting manufacturers. Tariffs were cited as problematic by respondents in every industry, with some taking issue with the disorderly manner in which the import duties were being imposed. Trump's Liberation Day tariff announcement on April 2 ushered in sweeping duties on most imports from U.S. trade partners, including a hike in duties on Chinese goods to 145%, sparking a trade war with Beijing. But Trump also suspended reciprocal tariffs against trade partners for 90 days. We expect the contraction for the manufacturing sector to deepen through the summer, even if tariffs, especially those on imports from China, are eased soon, said Ben Ayers, senior economist at Nationwide. Let's read that again. We expect the contraction for the manufacturing sector to deepen through the summer, even if tariffs, especially those on imports from China, are eased soon. The ISM manufacturing PMI dropped to a 5-month low of 48.7 last month from 49 in March. A PMI reading below 50 indicates contraction in the manufacturing sector, which accounts for 10% of the economy. A flood of imports as businesses sought to get ahead of tariffs weighed on gross domestic product in the first quarter. The PMI could have dropped more last month were it not for longer delivery times and higher inventory as factories sought to bring in more inputs to beat tariffs. Lengthening in suppliers' delivery times is normally associated with a strong economy, which would be positive contribution to the PMI, but that is not the case this time. I would argue that the health of the factory sector is worse than the headline index would suggest, said Stephen Stanley, chief U.S. economist at Santander U.S. Capital Markets. The chaos around tariffs is causing a steep fall in activity, but at the same time producing longer delivery times and inventory accumulation. Yeah. Manufacturing is heavily reliant on imported raw materials. The second straight month decline in the PMI and the brief recovery in manufacturing had been driven by hopes for a less stringent regulatory environment under the Trump administration and the Federal Reserve interest rate cuts. 11 industries, including electrical equipment, appliances, and components, computer and electronic products and machinery reported growth. Among the 6 reporting contraction were wood, paper products, and transportation equipment. US stocks were trading higher. The dollar gained versus a basket of currencies, US Treasury yields rose. Transportation equipment manufacturers said tariffs were impacting operations, specifically noting that delayed border crossings and duties calculations that are complex and not completely understood. Makers of computer and electronic products reported that all inbound Chinese shipments are on hold, adding it is not feasible for our business or customers to sustain the pricing required to provide an acceptable margin. Machinery manufacturers said tariff whiplash is causing us major issues with customers. Some domestic producers were taking advantage of tariffs to raise prices. Makers of fabricated metal products noted that domestic producers are charging more for everything because they can. I mean, I think that's the missing piece from the public perception right now, that people don't realize these domestic producers will also take advantage of the environment and raise their prices, leading to inflation. Manufacturers of non-metallic mineral products reported that strategic procurement and supply chain are paralyzed in a world that changes daily due to tariffs. The ISM survey's forward-looking new order subindex improved 47 as businesses try to beat the duties from 45 in March. Production and factories remain depressed amid the worsening in suppliers' delivery performance. The survey's deliveries index increased to 55 from 53.5 in March. A reading above 50 indicates slower deliveries. Inventories at factories continue to rise, though at a moderate pace. Inventory growth is not a positive sign when demand is moving in the opposite direction. By the way, that's exactly what we're seeing on Tesla too. Inventory growth is not a positive sign when demand is moving in the opposite direction. So that means to me that production will have to drop even further. Let's continue. The recent expansion is considered a temporary move to avoid tariffs, and the levels will decline when such trade issues are resolved, said Timothy Fiore, who chairs the ISM Manufacturing Business Survey Committee. Supplier delivery performance reflects this pull forward activity and delays in clearing goods through ports of entry. The survey's measure of prices paid by manufacturers for inputs edged up to 70, the highest level since June 2022. So that's really interesting that the prices paid components are surging, even though they're already pretty high. And the Fed has been cutting. Unlike in 2022, the Fed was raising rapidly at that time. Factories continue to shed jobs, with Fiore noting that companies generally opted for layoffs because they're quicker to implement than attrition. But businesses in general have mostly adopted a wait and see attitude to the tariffs and are retaining their workforces while remaining cautious about adding headcount. A separate report from the Labor Department showed initial claims for state unemployment benefits jumped 18,000 to a seasonally adjusted 241,000 for the week ended April 26. Claims were boosted by school spring breaks in New York State. Economists expect tariffs to result in a wave of job losses, expected to be a drag on domestic demand. The duties already are prompting some companies to reduce staff. UPS said this week it would slash 20,000 jobs and shut 73 facilities as part of a planned reduction in deliveries for Amazon.com. While the labor market is far from recessionary territory, it could turn if other companies follow UPS's suit and start trimming payrolls, said Andrew Stetner, Director of Economy and Jobs at Century Foundation. The number of people receiving benefits after an initial week of aid, a proxy for hiring, soared to 83,000 to a seasonally adjusted 1.916 million during the week ending April 19, the highest level since November 2021. That's a major data point as well. This is the highest continued claims since November 2021. I'm actually going to take that down as a note. So May 1, continued claims jumped to 1.916 million, highest since November 2021. And if you remember, back then the economy was recovering from COVID shutdowns, and the continuing claims are plunging. So this is higher than throughout 2022, 2023, when we had a brief increase due to the regional banking crisis. So that's really interesting. This is something that I think Powell might highlight on next week. The claims data have no bearing on April's employment report scheduled for release on Friday. That's a stretch, I think. That's a stretch. Non-farm payrolls likely increased by 130,000 jobs last month after rising to 228,000 in March, a Reuters survey showed. The unemployment rate is forecast to be unchanged at 4.2%. Quote, we expect firms have already started slowing their hiring, and we expect to see news of that in tomorrow's payroll employment report, said Carl Weinberg, chief economist at High Frequency Economist. I think that I'm going to make a bet here with myself that today's May 1. I think that payrolls will come in tomorrow lower than expected, 130,000. So this will be April 25 job gains less than 130K, but let's say that's including adjustments to March and February 2025. Okay. So if the number comes at 150K, but the revisions to the previous numbers are higher than 20,000, then I win the bet. So we'll keep that in mind. We'll look into that. That comes out tomorrow morning. We expect. Okay, so we talked about that. Okay. Any questions, comments on this front? Otherwise, we're going to move on to Sal J says audio good. Thank you, Sal Sage. All right. We have McDonald's, Qualcomm, and then GM. In the meantime, markets are slightly positive, driven by Nvidia, Microsoft, and Meta. All right, let's go to McDonald's. McDonald's global sales post surprise drop as tariff chaos hurts consumer confidence. McDonald's posted a surprise drop in first quarter global comparable sales on Thursday as demand from cash-strapped diners in the US and Europe faltered on uncertainty sparked by chaotic tariffs. The world's largest fast food chain is navigating the toughest of market conditions, CEO said, as restaurant visits by lower and middle income customers fell in double-digit range from last year. That's pretty stunning. That's amazing. So this goes along with our theory that the higher income and kind of baby boomers are carrying the global economy, especially the US economy. And that's quite a revelation by McDonald's. Double-digit drop by restaurant visits, lower and middle income. I mean, the thing is, like, they hike their prices so much, and lower income folks obviously can't afford that. So that's interesting. McDonald's. The results echoed warnings from restaurant operators Domino's, Chipotle, Starbucks that Americans were spending less to dine out as inflation and bleak economic outlook dent consumer confidence. So this is hard data, right? A lot of times people say soft data is soft, but hard data is still strong. But this, in my mind, company earnings, visits are hard data. This is not soft data. These are not surveys. Yeah, this is very interesting. Actually, I took a note down the other day on the other ones. Let's see. Southwest Chipotle, Pepsi, negative commentary. So we'll add to that. McDonald's, Starbucks, Domino's. Tariff flip-flops by the Trump administration have worsened world pressures and disrupted businesses, threatening to push up costs and upend supply chains. The US economy is struggling, with latest data showing it contracted for the first time in 3 years in the first quarter, ramping up to chances of a recession in 2025. Less affluent consumers are most vulnerable to the impact of inflation, and one of the first areas where they'll cut back is dining out. Yep, exactly. And I've been highlighting that for a very long time, for several months actually. It's apparent in the data and that I watch. So this is not really news, but it's good to have the confirmation from the CEOs. McDonald's share were down 2% early trading after gaining about 10% this year. The company has tried to spur demand by ramping up its value menu offers, such as $5 meal deal, similar to its rivals. Executives at McDonald's will offer the $5 meal throughout 2025. Still, global comparable sales fell 1%, while analysts were expecting a 1% rise. So that's a massive drop for McDonald's. That's a 2% miss on analyst expectations. It's also very much in line with the Q1 US GDP. Now, this is global sales, not just US, but the US had been the shining stars, and I think that's where the change is mostly in the last couple of months here. So US GDP was expected to be slightly positive. It came in slightly negative in Q1. And McDonald's global same store sales, comparable sales, were expected to be 1% higher. It came in 1% lower. So it tracks. It tracks. I have this theory, kind of worldview, and looking at new data as they come in to see if it fits or contradicts the worldview. However, its business segment, where restaurants are operated by local partners, stood out with a 3.5% growth compared to last year, led by a sales recovery in the Middle East and Japan. Business segment. Okay. A demand hit in the Middle East showed signs of easing after last year's widespread informal boycotts of Western fast food chains over their perceived pro-Israel stance in the Gaza conflict. Excluding items, McDonald's earned 2.67 per share, a cent above estimates. Okay. It's also interesting that a lot of these companies are protecting their margins and letting the revenue growth go. That's, I think, very interesting. Give me 1 second. All right, so that's McDonald's. Next, we're going to read about Qualcomm and then GM. Any questions, comments? Please request to speak or leave a comment for the for YouTube channel. JR says, opinion on Meta CFO saying, so even with the capacity that we're bringing online in 2025, we're having a hard time meeting the demand that teams have for compute resources across the company. Yeah. So this is, I'm guessing this is for NVIDIA. I'm going to listen to the earnings call on Meta. I think Meta is very aggressive in terms of implementing AI and kind of plunging into AI efforts. They have the capital, they have the resources to do it, and I think they have a CEO who's also kind of risk taking, major entrepreneur, leading entrepreneur, obviously. So it's not that surprising that Meta stands out as the one company that is accelerating, AI efforts. Despite, we heard from Microsoft, Amazon canceling some data centers and others. But I guess to what I mean, what concerns me the most is how does this reflect for NVIDIA GPU demand? And just because Meta is increasing CapEx spend doesn't mean NVIDIA's revenues or profit margins will improve or will stop declining, and revenue growth and profit margins. And it could mean, for example, that maybe Meta will buy from GPUs from other places, or maybe Meta will pay more for other components of data centers. Maybe Meta is accelerating, pulling forward some CapEx spending from the following year. We also don't know if it more than offsets demand growth declines from other buyers. So it's certainly a point against an NVIDIA short. So I'm not surprised that NVIDIA sticks up today. But I don't think it's strong enough on a standalone basis to say pull the plug on the NVIDIA short position. So I'll continue to monitor. I'm going to read the Meta transcript, see what they exactly said. A lot of times these headlines will reflect what was actually said, and then we'll take it from there. JR says he said that after already guiding CapEx up. So even with the capacity that we're bringing online in 2025, we're having a hard time meeting the demand that teams have for compute resources across the company. Okay. If there's a specific question, just put in the specific question. But those are my initial thoughts on Meta. I'm also listening to Mark Zuckerberg's interview. I was listening to this morning with Dwarkesh Patel. This was published yesterday, and it's very informative. I like Mark. I think he's a good guy. He's very smart, good CEO, and all of his conversations are very insightful. All right, let's go to Onano. Let's go to Qualcomm. Mobile chip designer Qualcomm on Wednesday forecast third quarter revenue that would not meet estimates, joining other tech companies such as Snap and Samsung that voiced concerns about the effects of US President Trump's trade war. Qualcomm third quarter estimates reflected the impact of the tariffs as they stand today. CFO Akash Palkiva said in a conference call with analysts following the results. But he said the situation could change due to rapid developments in the trade tensions. We do not see any material direct impact. There's smaller direct impact and some minor changes in demand, the CFO said in a reference to the tariffs. It's difficult for us to predict. Qualcomm forecasts third quarter revenue just shy of Wall Street estimates, expecting tepid demand for smartphone chips. Apple, which is known to be Qualcomm's largest customer, has also begun to produce its own modem chips and is expected by analysts to buy fewer of Qualcomm's modems as it introduces its homegrown chips into more products. Qualcomm's stock, which was already down more than 3% year to date, sank 6% extended trading as investors have worried about global trade turmoil. The company's chips are currently excluded from Trump's steep tariffs, but slower economic growth will likely hit demand. In a securities filing on Wednesday, Qualcomm said it was uncertain about the effects of tariffs and other related actions might have on its business. Tariff uncertainties will definitely have an impact to its top-line outlook, as Qualcomm is exposed to the smartphone, consumer IoT, and the automotive end markets, Summit Insight Group analyst Kinga Chan said. For its current fiscal quarter, the company expects a sales range with a midpoint of $10.3 billion, below analysts' average estimates of $10.35 billion. So it's not that much. World's largest supplier of modem chips that connect smartphones to wireless data networks. It expects adjusted profits between $2.6 per share to $2.8 per share, the midpoint of above estimates of $2.67 per share. So just on that, it's not that much of a difference from what was expected. And the stock is down 8%. 15 PE ratio. Okay. Apple Qualcomm divorce. Despite mounting competition in China's domestic chip sector, Qualcomm has retained its stronghold of the smartphone market, supplying both Apple and Chinese handsets makers such as Xiaomi, Oppo, and Vivo. However, Apple's increasing push toward building in-house modem chips threatens Qualcomm's share of the iPhone maker's silicon components. In the second quarter, Apple accounted for 27% of Qualcomm's revenue, Chan said. Apple's long telegraphed move to bring modem development in-house is less of a surprise and has been more of a slow motion divorce, with Qualcomm playing the role of the efficient but increasingly expendable X, said Michael Schulman, Running Point Capital investment chief. In the conference call, CFO said that Qualcomm is forecasting it will retain a 70% share in the products Apple launches in the fall, when the iPhone maker typically unveils its latest gadgets. Stillman said that he expects Apple to supply no revenue to Qualcomm by 2027. Even though Qualcomm chips so far have been excluded from Trump's steep tariffs, escalating trade tensions have cast a shadow over the company's revenue from its biggest market. China accounted for about 46% of its total sales in the last fiscal year. Qualcomm categorized geographic revenue on the base of customers' headquarters. As we navigate the current macroeconomic and trade environment, we remain focused on the critical factors we can control: our leading technology roadmap, best-in-class product portfolio, strong customer relationships, and operational efficiency, CEO said. While the US government has granted smartphones and chips special exclusions from steep tariffs, Trump has warned of sector-specific levies to come from semiconductors. Global smartphone shipments rose 1.5% in the first 3 months of the year, according to data from research firm IDC, with major Qualcomm customer Apple front-loading supply to sidestep potential tariffs. Qualcomm reported adjusted, etc. Licensing segment generated sales of 1.3 billion, while chip business reported revenue of 9.5 billion. Okay, that's that. Any questions, comments? Otherwise, we're going to switch to GM. I don't see any. Let's go to GM. GM cuts 2025 profit forecast, expects up to $5 billion tariff impact. GM cut its 2025 profit forecast on Thursday after receiving some clarity and a reprieve from the White House this week on automotive tariffs. CEO Mayor Barra told shareholders in a letter that the company would maintain dialogue with the Trump administration on trade and other policies as they evolve. There are ongoing discussions with key trade partners that may also have an impact, Barra said. The Detroit automaker released the forecast 2 days after pulling a previous one issued in January that did not take into account the automotive tariffs and after the Trump administration made changes to them. Shares of the company were up about 1% morning trading. The automaker expects an annual adjusted core profit of between $10 to $12 billion, including a current tariff exposure of between $4 and $5 billion. So GM is forecasting a tariff exposure of $4 to $5 billion in 2025. And I suspect Tesla's hit to Tesla's is also going to be more than in the billions range. The exposure includes about $2 billion on more affordable vehicles GM imports from South Korea, where it makes entry-level Chevy and Buick models, CFO told analysts on the Thursday call. The automaker's new guidance assumes it can offset at least 30% of the tariff costs, Jacobson said. Since the election, our manufacturing and supply chain teams have been focused on developing strategies to help mitigate the impact of potential tariffs, Jacobson said. These strategies are now actively being put into action. We'll take additional mitigation measures, including cost reduction targets where it makes sense to do so. To help mitigate tariff impact, GM is working with suppliers to further increase their US content for higher levels of compliance with the USMCA trade agreement, Barra told analysts. The automaker is also increasing production of its US-made battery modules, which Barra said is a low-cost way to increase US content. Interesting. Alongside these actions, we are scrutinizing our discretionary spending everywhere, she said. GM's previous guidance for earnings before interest and taxes was between 13.7 and $15.7 billion. And Tesla is at 0%. Tesla on an operating basis, operating margin is very close to zero, and I think it's going to turn zero soon, negative soon. And at the same time, GM is making 13.7 to 15, and more than 10 billion with the revised. I don't think people realize. I don't think people appreciate this fact. It expects to earn annual net income between 8 to 10 billion, down from its prior range of 11 to 12 billion. GM anticipates 2025 full year capital spending will be between 10 to 11 billion dollars. In an interview with CNBC Thursday morning, Barra said the automaker expected to make further announcements on plans to increase US production. We are making a commitment that we're going to bring more production back to this country to build on what we already have, Barra said. Reuters broke the news that GM will increase light-duty truck production at its Fort Wayne, Indiana assembly plant. Barra also said the company is assuming a pricing environment that's similar to what it is today, even though industry estimates find new vehicle prices could increase by thousands of dollars under tariffs. That's exactly what the Tesla CFO said as well, that they expect to get thousands of dollars, couple thousand dollars, he said, couple $1,000 per vehicle hit. And GM is saying the same thing. So I don't see how Tesla is better positioned to handle this than traditional automakers. In fact, what I would say is the other automakers have a lot more capital than Tesla does. Well, I'm not talking about cash, but also in terms of free cash flow to maneuver around these things. Trump's 25% automotive tariffs went into place at the beginning of April. After weeks of automakers lobbying for leniency, the Trump administration this week announced measures to alleviate some of the tariff costs while the companies work on increasing their US footprints. The changes allow automakers to offset tariffs for imported auto parts used in US assembled vehicles. Additionally, the vehicles and parts will no longer be subject to Trump's other tariffs, including 25% levies on steel and aluminum, as well as 10% duties applied to most other countries. So that's going to be interesting. So is that so? Does that mean if a supplier buys steel or aluminum that goes into a car that doesn't they don't need to pay 25% levies? I mean, the implementation of this is going to be very interesting, I think. So let's say that supplier is not subject to 25%, but another supplier who gets steel and aluminum for another purpose, for another end market, is subject to it. So how does that impact the overall market, overall steel and aluminum prices? Okay, I'll have to think about this. The tariffs also led Stellantis, maker of Jeeps and Ram trucks, and GM's crosstown rival, to pull its guidance on Wednesday. On a more positive note, executives have seen new vehicle sales increase with consumers rushing to buy before tariffs affect prices. So we're going to see, as we've seen in March, we're going to see a bit of a pull forward in April and May and maybe June. So Q2 will likely benefit from a bit of a pull forward of demand. Like Ford, for example, committed to not raising its prices until I think June or July. And I think this is in part driven by the fact that consumers can't really afford higher prices anyway. But that we'll see what happens by Q3. So a lot of companies have accelerated their imports. They increase their inventories to, um, weather a storm during the trading talks. So again, we're not going to see the impact of these things until on inflation reports until Q3. But the weakness on the consumer side is, I think, pretty evident at this point. Retail sales were down. All these companies are reporting that there's weakness, especially in the lower income, middle income, and the higher income folks and baby boomers are still kind of keeping the economy going, U.S. economy going. But they had a bit of a stumble too after the stock markets dropped 10% or more. All right. On a more positive note, Exit has seen new vehicles increase. Ford on Thursday posted 16% sales increase in April. GM on Tuesday said it saw a 20% increase in the month, marking the best April for retail sales or sales to individual customers since 2007. Now, on the other hand, Tesla isn't seeing that. Tesla's delivery estimates are declining very rapidly. So Tesla is continuing to lose market share in April. Highly recommend people join Troy Tesla's Patreon. And I'll pin at the top of their screens a couple of charts. This chart comes from Kalshi. You can see the deliveries estimates in Q2 declining very rapidly from 385,000 just a few days ago to now 368,000 units. And I think some people expected, some credible folks expected more than 400,000 to start at the beginning of April. People thought that Q2 would see a bounce from Q1 in terms of deliveries demand, because they thought that maybe Model Y production ramp, so the supply issue, was the driver behind the massive misses in Q1. And they said that when Model Y production improves, we should see a bounce in Q2. And I think that was wishful thinking. I said at the time it was wishful thinking, and now it's proving to be wishful thinking. So we're seeing these estimates drop quite rapidly. And I think the stock price will follow. Um, we're also getting some European data that shows very rapid plunges in Tesla sales across Europe, as expected. And despite ample Model Y supply. The new Model Y, already has 0% or very low APR financing in China and Europe, despite having been in the markets for only a couple of months. So that's a massive indication. That's a very major indication that the demand for the new Model Y is very low. Just like the demand for the new Model 3 really underwhelmed observers and management. So I would be surprised if these delivery estimates for Q2, Q3, Q4, so 2025 overall as well, didn't continue to decline. I would be shocked if in the coming days, weeks, and months, we didn't see analysts revising their estimates lower and the stock price following the fundamentals. So that's the end of GM. Another graph at the top of our screens is the Model Y. This is a 2024 Model Y long range all-wheel drive. 2024 Model Y long range all-wheel drive listed at less than $30,000, so $29,495. Okay. This car is only 1 year old. It has only 18,000 miles on it. All right. And if you try to buy this car today with the gray paint and everything, I think it's priced at more than $52,000. So the quickly plunging used Tesla resale values, used Tesla average listing price. This is, by the way, the listing price. So you can go to the dealer and negotiate a much lower price. You can probably get this for $28,000, which is stunning, right? This is a hardware for people sometimes say, "Oh, it's a hardware 3 vehicle. It's not a hardware 4 vehicle, so its resale value doesn't isn't relevant." I don't think so, because 99% of people don't even know the difference between hardware 3 and hardware 4. It's only just a few thousand people on X that follow Tesla stock very closely, and they know the difference, but they kind of extrapolate to the average buyer and say, "Oh, they would definitely not buy the 2023 version. They would go for the 2024 version because um, hardware 3, hardware 4." But that's not the case. That's not the case. We're also seeing 2024 Model Y uh, prices decline very rapidly. Tesla in the US started putting hardware 4 into Model Y in May of 2023. Okay. So this should be very alarming to Tesla investors. This trend of plunging Tesla resale values gotta be very alarming for Tesla investors, because it's a harbinger of things to come. And this is not the only example. I mean, I post these examples very frequently, and I'll post a couple more here at the top of our screens if you wish. Actually, I'll post a chart that shows used Tesla prices fell at a rate 6 times that of the overall used car market. And I'll post this on YouTube as well for those watching this on YouTube. This is a very important chart. Okay. Um, Give me 1 second. This one right here. Used Tesla prices fell at a rate 6 times that of the overall used car market. Specifically, Tesla resale values have dropped 7.3% year over year, compared to 1.2% decline for the overall market. Cybertruck experienced the largest price drops. I don't think Cybertruck is going to survive. I think the Cybertruck program will be scrapped, and Tesla will end up realizing billions of dollars of losses on the inventory, on the production equipment, and severance to the employees who will work on the Cybertruck production line. I don't think Cybertruck has a future at this point. Um, and if you look at the numbers that are in this chart, you can see, the columns are average price last 30 days, last 90 days, year over year. And the year over year is 1.19% versus 7.26%. So that's 6 times. But if you look at the last 90 days, the difference between those two figures, car goods index and Tesla number, 2.9% positive and 2% negative, 1.95%. That is almost 5%. So most of the difference came in the last 90 days. Even though folks are rushing to dealerships to buy traditional ICE hybrid vehicles ahead of tariffs, we're not seeing the same surge in demand for Teslas, used Teslas. We're not seeing the same surge in demand for used Teslas. Okay, so that's the big problem. That's the big problem for folks. Um, for Tesla investors, I think. And this is mostly driven by, as you can see, Model Y. Um, the Model Y prices, used values dropped 1.5% in the last 30 days, more than the Tesla average. In the last 90 days, it dropped by 2.9%, more than the 1.9% average for Tesla. We saw similar drops in Model 3 as new Model 3 was the new Model 3 was ramping, but it didn't translate to demand for the new Model 3. Tesla ended up introducing 0% financing for the new Model 3 very early on, and it's having to do so again at a much faster pace for the new Model Y. And I suspect that we're going to get a 0% or some 1% low APR financing for the new Model Y sometime in the next couple of weeks here. Sometime in May. And that will be the final nail in the coffin for Tesla's operating margin. As soon as Tesla does that, that means negative operating margin for Q2 is secured. All right. I see Machine in the crowd. If he wants to come up, he's welcome to chat a little bit. Otherwise, I'm going to end the space. So let's give him a couple minutes to hear this delayed. Oh, there he is. Machine.
How are you?
I'm good. How are you? I'm good. How you doing?
I'm fine. Had a trail run. Looking at
Nice.
this, you remind me of the used car trends, which you just verified. I just went to look again because I looked a month ago, and the discrepancy has just gotten worse. As you said, I mean, I'm just repeating basically what you've said, right? The used car market demand, the prices have gone up. They were in the last month. It's gone up like the average price maybe $700, and Tesla prices, Model 3, Model Y, are down, and they're the only ones. Every other car maker prices are up. So that difference, right? You're controlling for what other cars are doing in this period of time because there's seasonality, and Teslas are losing value. And I totally agree with you. We're seeing financing deals in China, and now you're predicting in the US. It just seems like I don't know how much they're selling a higher margin Model Y, but that stopped, right? I mean, they've moved on to regular Model Ys with the new version. I don't know what those list prices are, so you're thinking in totality. Predominantly the Tesla is Model 3, Model Y. That's their revenue base.
Model Y. Yeah,
Model Y.
all the profit is coming from Model Y.
And you're seeing the current list prices for Model Y are
and Model Y in US. That's it.
right.
There's some profit coming from Model Y in Europe. That's it. Literally one product, two regions, and in the US, 90% of EV sales are in a handful of leftist states. Actually, it's not left. That's not true. But a handful of states, and a lot of it is in ZEV states, which are the customer base that Elon's antagonizing. So that's why we're seeing this massive drops across all these important regions. 90% of sales are in China, Europe, and California, and a couple of the leftist states. So Europe obviously is like a one big California in terms of, and Canada, one big California in terms of political views, and they're not buying it. And I mean, it's impossible to think that Elon isn't doing this on purpose. But so one product, just a handful of regions. In China, Tesla obviously doesn't make any money, whether it's Model Y or Model 3, because of competition, which is not going to go away. They're only getting better and better. And in Europe, you have a proliferation of EVs because of regulatory requirements and trusted domestic brands that customers are preferring increasingly so. So I would expect Tesla's European profits to plunge as well in the coming quarters. And in the US, you could kind of hang your head to the idea that Tesla's robotaxis will dominate in the US and the Chinese aren't allowed to compete in the US because of government protectionism, etc. But now you have Waymo and Toyota partnership. And I suspect that Toyota will ramp autonomous vehicles quicker with Waymo's help than Tesla ever will. And in today's press conference, I think Trump was thanking the US head of Toyota. So Toyota generates tens of billions of dollars. and makes investments, very large investments in the US. So Toyota is not BYD in terms of importance to the US. So they're not going to go away in the US. They also have a very strong customer base, infrastructure. They employ a lot of Americans, etc. Machine.
Yeah, I mean, I find it fascinating that people will rationalize that there's literally going to be no competitors in the FSD space. I think it's reasonable to say that Tesla could be lower cost, but it's hard to hold that view and the view that they're going to make enormous operating margins and not expect some other competitor to be there. Even if Waymo has a higher cost per mile, if indeed the gross margins are so large, then even Waymo will be able to survive even at higher prices. Yes, their operating margins will be lower, but they will still be around because it's so lucrative. So there will be price compression based on competitors, and that's Waymo. Obviously, in the U.S. is already well established. Like they're probably going to make it. It doesn't mean they're going to be hugely profitable, but they're going to be there to set prices. And in China, we know that's like a done deal. Tesla is not going to be making a ton of money in China.
Tesla
So
China is losing money
I'm talking
at
about the future
90%.
FSD.
Yeah, Tesla China is losing money at 90% for capacity utilization, which is stunning, right? Because generally speaking, you need 60% to get to profitability. But in China, competition is so strong that competitors are selling better cars at half the prices that Tesla is having to respond, whether it's lower prices or lower financing or insurance subsidies, etc. So Tesla is not making any money in China; they're losing money in China. Gross margin is negative. So that tells me uh, now there's so that's one fact. Let me give you one more fact, and then we're going to reach a conclusion. The other fact is to this date, until 2025, Tesla's automotive market was growing, and EVs, so these new energy vehicles, were eating into market share of ICE vehicles. Even then, Tesla was losing market share, and now the EV percentages have actually stabilized because they're basically at 80% of the market already. These new energy vehicles are basically at 80% of the market already. So now it's going to be pretty much a zero sum game in terms of market share. So Tesla's market share declines in China will accelerate. So you have the really toxic combination of negative gross margins for Tesla in China, plus declining market share, which means, because the market is not growing, which means declining capacity utilization, which means higher fixed cost allocation per vehicle, which means even more negative gross margins. Therefore, I would be shocked if Tesla still continues to sell in China after the next couple of years. I think Tesla will have to exit China.
And that's a bold prediction, Cotton. Hope it
Hmm.
works out for you.
Hmm.
Uh, I don't know about that. I get your framework there.
I mean, just
Makes
keep in
sense.
mind that GM and many others are exiting China. They're closing factories, they're selling factories of pennies on the dollar, and they're exiting because they can't compete.
Yeah, I don't know. I don't know if they're going to go that far. Like if they're around zero, they might continue it on the basis of even at minimum hyping. Well, eventually we're going to have robo taxis in China, and so we're going to build all these vehicles, even if we're not making much money, or even if we're losing a little bit of money, and eventually there'll be robo taxis. And I think if you just stop producing vehicles, that, that you can't keep that narrative up, and that will hurt the stock price more. And I think so. I don't think they'll do that. Just from a stock price stability standpoint. I think they'll just keep producing vehicles there unless they're actually really start losing money. And I don't know if it's going to get that bad. So, but I get your point, right?
Okay, so okay, I respect your view. I think you're wrong, but I respect your view. So let's be a bit more specific. What do you mean by if they start losing even more money? Like, can you put some numbers on it? Let's say you're the CEO, and Tesla China is losing money, and what in your mind that coming out of the Tesla Shanghai factory is too much losing money?
Probably like 10 to 20 cents per share per quarter.
Okay,
That's that. I don't, I mean, I can't read into the minds of Elon Musk. And when he looks at the financials and be like, oh man, it's that bad? Like, we got to shut that down. And if there's no trajectory for it to improve again, um, yeah, I'm just saying, like, it's not just the instantaneous state is low. They have to have a trajectory that they know is going to get worse or stay at that level
but that's the case
for
today,
for
right?
years.
That's the case today.
What do you
The
think? How
current
much do you think they're
state is
losing?
low.
How much
The
do you think they're
current,
losing?
hold on, I'll tell you. Um, I wouldn't be surprised if Tesla China was losing more than $1 billion today per year.
Right. Per year, $1 billion. Right. That's probably, so I guess I'm saying that that would probably have to go up. I might have to think through my math, but to be consistent with what I said on a per share basis. But I guess losing 20 cents per share, losing 80 cents a year, almost $1 would be like over 3 billion. So
Yeah, but you said 10 cents.
yeah, I said 10 to 20.
Yeah. So in my mind, I think they're already losing more than that.
They're close. Yeah.
Hmm.
I'm just saying,
And the trajectory is worse because, like I said, until now, the EV market was growing together. So everybody was kind of benefiting from that growth. The tides were rising, all boats were rising in the EV market in
I,
China.
I have
But
a
that's
question
not the
for you.
case anymore. That's not the case anymore,
How
right?
localized is Tesla China material production? I
I
assume it's
don't know,
very
90%.
90%. So there's still 10% coming from other Southeast Asian countries or
I
Europe
don't know.
or US?
I don't know. I'm guessing it's mostly localized, right?
Yeah. I'm just wondering, like, this whole tariff war with China, I presume is mostly Tesla's going to avoid the cost of that mostly, but I imagine there must be some cost increase.
Hold on. We're in the Tesla China discussion right now. We can switch to tariff discussion in a second, but um, yeah, I don't think Tesla China uh, necessarily gets hurt from the tariff wars. I get your points, but like I said, I think the situation is already bad. They're already definitely negative. I know that much. I don't know how negative it is, but even if they're losing $1,000 per car, that's almost $2 billion. So just a few hundred million. I mean, that's what I'm trying to say. Like that's what people don't understand sometimes. Like my point, sometimes isn't that clear, is that when things turn south in the automotive market, which is a very high fixed cost market, when things turn south, they can get really bad really quickly because it's not easy to scale back. Um, you still have this massive cost structure, right? Even at the pace at Elon laid people off in the US, you still have this massive cost base. Your supply chain is in place. You have multi-year contracts in place. That doesn't disappear overnight just because your demand vanished. And on top of that, BYD and other Chinese automakers have really accelerated it. I mean, BYD has become the technology leader. It's not just about volume for them; they're also technology leader now. CATL is really pulled ahead in terms of battery production, battery technology. And Tesla, I guess, had these ambitions to catch up, but they didn't make even a dent in CATL's leadership. So you're dependent on your suppliers, okay? you are exposed to political variability, geopolitics, and you're losing market share and you're losing money already, even at full capacity utilization. It can only get worse. Like, how is it going to get better? You know what I mean? So I think they're going to pull the plug pretty soon, actually. Go ahead.
But other than that, how was the play, Mrs. Lincoln?
Yeah, exactly. Yeah, exactly.
I just think, it's funny how far things have come. I know I see some classic bears in here and bulls, and you and I were obviously bearish a long time ago. And things have changed. And it's interesting now, kind of the pivot is that really anyone who's bullish still, they've totally changed their narrative to everything's about FSD, right? No one even cares anymore about actual making money and valuations. Like, as long as this future is secured, and they really haven't done any deep dive into assessing the actual probability of various outcomes of earnings based on FSD. And yet they put in all their money in this company. And I find that extremely risky. And I'm just curious for you, like, what do you think? Like, I just from a big picture, like top down view of modeling this out, if I just looked at how much revenue Tesla could get as a robotaxi service, let's say in 5, 10 years, and I just spitball some number. I'm taking like Uber's revenue and 10xing it, like this, which to me is already quite extreme. But I'm like, all right, let's say they got 10x the revenue a year. They're doing like $400 billion a year in revenue, and then I say, what's like a standard healthy company's operating margin in this sort of in space, assuming that there's some competitors.
See, I don't agree. I don't agree with that approach.
How would you approach it?
Well, first of all, there's not going to be a robotaxi in the next 5 years. It's just technologically impossible. And in the next 10 years, let's say that Tesla continues on this path, which I think they're not going to do because Waymo is going to have scaled to more than a dozen cities that has most of the rideshare demand anyway by then. I think the approach that I heard you talk about talk with Meta on that as well, and you guys were kind of discussing these assumed operating margins and stuff. It's just like you have zero sports for saying 20% operating margin, zero, right? Um, in the future, let's say 5 to 10 years from today, when Waymo has scaled to more than a dozen cities, and they're operating tens of thousands of vehicles, if not hundreds of thousands of vehicles by then, which is, I think, very highly likely. By 2030, I think Waymo is going to have hundreds of thousands of robotaxis in more than a dozen cities, and maybe a couple dozen internationally. I don't know how Tesla gets to even profitability, let alone 20% operating margin as a new entrant. You're going to have a very dominant technology leader with strong partnerships in Hyundai, Xiaomi, Toyota, and they've proven to progress at a very rapid pace. I don't know how you get to 20% margin at that point. So I think robotaxi future is still needs to be proven. Still for Tesla, it's still very much a 0 to 1 kind of issue. So until you kind of get to that one, these assumptions about revenues and profit margins and miles traveled, and I'm going to put a profit margin on this and that is ridiculous, I think. Go ahead.
Well, I mean, your point's totally fair. And just to be clear, I was making those numbers up as what I thought would have been sort of a best case scenario to kind of still show that even with those numbers, the sort of operating income that you were going to derive wouldn't be supporting a valuation really that much higher than today. Even with 15% operating margins on $400 billion in revenue, you could value that company at about $1 trillion. And these people are basically betting that this company is going to like 5x in value because of robotaxis. And I'm looking at like the best case scenario, which as you pointed out is probably not likely, is not really a good investment. And these people be like, oh no, operating margins 15%. No, it's going to be 30. Like, really? You think you're going to have Apple's operating margins? Apple's a brand. Tesla's brand has been pooped on, and no one cares about taking a Tesla over a Waymo. In fact, they're probably going to prefer the Waymo over the Tesla. So I just find this bull argument just terrible.
Exactly. Now, let me ask you this. In 2030s, fast forward to 2030s, what do you think is going to be the cost for a new entrant to come in?
Yeah, I mean, the cost to develop the software is going to be lower. Everything gets commoditized over time.
So let's say a venture capital backed new entrant, for them to, let's say, get to a robotaxi market, say about 10,000 vehicles. How much do you think it would cost them?
I don't know. If you're talking about hardware versus software, I was thinking mostly technically.
No, both. They want to do their own software. They want to do their own hardware. I mean, I guess you could just buy the hardware, right? You can't just buy cars.
Yeah, I think you would just see collaboration between some automaker on the down low.
So how much do you think is going to be software cost of develop autonomous driving in the 2030s?
I mean, I'm just totally winging here, but probably a few billion.
Yeah, I don't think it will be that much.
I don't think that's a limiting factor.
I think it's going to be in the millions. I think it's going to be in the millions.
It could be. I mean, honestly, like at some point, someone's going to be able to reverse engineer. Someone's going to be able to hack the car computer with the localized model, and it's not going to be perfect. We're going to use that as a starting point to then fine tune their own model. Like there's going to be ways, especially in China, they're going to totally hack this and progress from there. And yes, they're going to still need some of their own data, but like at that point, there's going to be so much simulations, realistic simulations that have been learned from real data and available, and people will use that as a proxy for getting in new real data. All this stuff's not going to be perfect, but it's going to get them pretty far along. And so this technology at some point will be commoditized, right? The whole point was that initially Tesla was ahead because they had so much data and were developing models ahead of other people outside of Waymo. But there's a limit to that time, right? And you need to act quickly. And right now, that's not even the case, let alone in 5 to 10 years. So I agree with you that someone else will be able to come in for much less money than Tesla's doing now. That's how it is with every technology, and catch up at a faster rate. And are they going to be perfect? Are they going to have a car that costs as cheaply as Tesla's? No, Tesla could be the best in class, but there will be competitors putting some price pressure downward on how much Tesla can charge per ride. And that price pressure downward means Tesla will not be getting some extravagant operating margins.
Okay. What do you think will be Tesla's bottom line this year? Net income gap.
I don't know. I'm not paying enough attention to energy. I assume energy. I don't know in the first quarter how that came out. I imagine that should do better. Do okay throughout the year. I don't know if Shanghai production will start hitting revenue accounting this year. I could see what did they print? Like 30 cents?
Mm.
I don't know if they'll hit $2. Somewhere between $1. $1.15, $2.
So
I
you
would
think
say.
Tesla will make about $5 billion in net income gap this year?
Yeah.
You want to bet on that?
Yeah. Okay.
Okay.
What do you? Yeah, you're clearly on the under.
Mm-hmm.
Well, I'm not betting over. Uh, I said let's say $1.50. You bet under. So $1.50 is going to be. Is that what you guessed? Like 5 billion?
Yeah,
I guess that's
5
about.
billion.
Yeah.
Right.
Okay. So I'm guessing over 5 billion. You're under.
Mm-hmm. Tesla gap net income. You're saying more than 5 billion in 2025. Uh, gap net income. Yeah, gap income. Let's just say net income in 2025. Oh, okay, so yes is machine, and your handle. Hold on a second. And is for machine. Okay. These underscore people. Okay. And
We
then
all
no.
we all can make our accounts as early as you. Our third or fourth or fifth accounts or whatever one this is.
Mm-hmm. Tesla 25 net income. All right. We have a bet. Coffee bet of the day. Pinned it at the top.
Wow, just like old times.
Mm-hmm. Just
Just
like
with
old
much less
times.
people paying attention now.
It's okay. All right. What would change your mind? So you're really betting this on energy then, right?
Correct.
Do you expect
And
do you expect an acceleration in FSD take rate this year?
um, my instinct is to say no, but and part of that is just because why would it accelerate from the status quo? In addition to if there is a recession or anyone starts pinching pennies more, that is totally a luxury, and less people will take it. So actually, it could go down instead of up. On the other hand, obviously, if the technology becomes very, very good, then maybe there'll be a higher take rate. But you know what? Honestly, so many people say it's so good right now, and it's not actually unsupervised, but it's so good. Then what's stopping people right now, right, from
Hmm.
getting it? Because it's not like,
They
oh,
don't know. They just don't know. Machine. They
nah,
just if they just
right.
advertise. If they just advertise.
Um, so I think there's not really room there for improvement until you get to actually unsupervised. Because what if you went from whatever their true disengagement rate is now, if you went up 2x or 3x more, is anyone going to care? Is that going to change anyone's mind about
Hmm.
buying this? No,
Hmm.
right? If it was unsupervised, hey, I can go, sleep in my car or whatever. That's a different story. And I don't think it's going to get there
Mm-mm.
this year, the
No
way they're
way.
trending. So no, I think it's likely not, unless
Hmm.
they actually advertise. I mean, it's funny. My company is starting to is like advertising, like, like you know they've made much less money than Tesla, and that's part of their growth strategy. Tesla's like anti-growth.
Okay. So you want to talk some macro?
Sure.
So in the morning at 8:30 a.m. Eastern, we got the initial weekly claims that came in slightly higher than expected, 240,000, higher than expected, 220,000, and more importantly, continued claims. Continued claims. By the way, people think it's continuing claims, but that's not true. It's continued claims. Came in at 1.916 million, so 1.92 million, which is the highest since November 2021. November 2021. Okay, and that's when the employment market was recovering from COVID shutdowns. So it was on the way down. All right. So this is a really bad employment market. Okay. People, when they get laid off, they have a really hard time finding a new job today. It takes them about a couple of months, 2 to 3 months. So they kind of run out of unemployment benefits. They work down their savings. They have a hard time finding a job. And now we're seeing jobless numbers increase slightly as well. It can accelerate, right? It can accelerate. We don't know yet if that will happen. These are still very low initial weekly claims. Until it crosses about 300,000, you can't. It's hard to call it a recession. Okay, but this is the point. This is the thing that everyone is watching. Everyone's watching initial weekly claims. It's kind of crazy how so focused are people are in this one specific metric. Every CNBC analyst, every macro analyst on podcasts, every person is watching initial weekly claims. It's fucking nuts. All right. So therefore, when this happened today at 8:30 a.m., yields plunged across the curve. Yields plunged. 2-year, 5-year, 10-year, whatever you want to look at. Even the 6-month yield plunged. Okay. People were so certain that the Fed will cut rates after this meeting. Yet at 10 a.m., once we got the ISM manufacturing index prices paid, yields are now up 10 basis points. 2-year treasury yield is up 10 basis points. The 10-year treasury yield is up 6 basis points, etc. 10 years that now at 424. Where do you think? How do you kind of think about these volatility? It's so crazy that these long-term U.S. Treasury yields are swinging 5 basis points down in the morning, 10 basis points up in the afternoon. How do you think about this?
I think, as a data scientist, that no one has any clue what's going to happen. That's what I think, and that's reflected in the market volatility. Economics, is based on really limited data historically. You can look at instances of certain conditions of GDP and interest rates and what happens. People talk about inverted yield curves and all that. And it's really based on like 10 data points, which from a statistical standpoint is a joke to say that that law is going to apply in the future. And I just think we're now in a territory where you have, even within one country, the president's whims of, assessing are we going to do tariffs or not, and the effects of that are just no one knows, right? Are you even going to have tariffs or not? What's the probability of that? The probability of high, 100% tariffs, even a 10% tariff. Trying to model that out, and the confidence in the U.S. and all these variables are, each variable is not well predicted right now, and so any sentiment change on one of those variables can cause sentiment change on what you think is going to happen to yield curve and recession risks and stock markets. So I know my answer sounds like BS, just hand waving, but I just think there's all these factors in play that model out the sort of macro results, and no one has any high confidence in any of them. And I think that's changing daily. I'm still surprised that, excuse me if I'm missing something, but like I just see on the news, like there's the ships coming in from China and they're at port of Long Beach, and there's 30% less than normal. And has this been accounted for fully? Like, what effect is that going to have on the economy? Is it just, as the president says, just dolls, extra dolls that kids don't need? They're going to pay a little more for their dolls. Is it just iPhones that people don't need? Or is it a lot of things that maybe,
Yeah.
it's not food, but it's something else, and people are going to have to pay more? And what effect is that going to have? And it's going to slow down earnings. And I just, there's so many things. Like, I don't know. That's my answer. I do not know. And so I don't think anyone knows.
Yeah, that's what a lot of people do. Just because they don't know, they think other people don't know.
I
Pretty
get it.
amazing
I
to
get
me.
it.
It's
So,
really
but I'm just
amazing
saying, I'm
when
explaining to
I
you
hear that when I hear that from people, it always like stuns me. Like, how the fuck do
what
you know what 8 billion people know?
absolutely. But my point is, you're asking, why is this volatility so high? And I think that's why. I'm not saying everyone doesn't know. I'm sure
Mhm.
a lot of macro experts can see very clearly certain trends and where it's going to go.
But I mean, this is very unusual, though. It's so unusual because it's employment index, new orders index, all contractionary, right? But the prices index rose to 69.8.
What's the
And
prices index? What's that?
price index. So this is, do you know how these ISM surveys work?
Not really.
They basically go out and ask purchasing managers. It can be S&P. There are two types of S&P Global PMIs, and then there's the ISM PMIs. They both have two, manufacturing and services. So there are four services total, and they are slightly geared differently. Okay, S&P Global is a little bit more global. ISM is a bit more US centric. Okay, S&P Global is kind of like designed for global questions, but it has a specific US survey. But the ISM is specifically designed for US. So therefore, markets kind of give a bit more weight on the ISM surveys. Okay, but S&P Global comes out a little earlier. So anyway, so what they do is they ask a bunch of questions, person managers, and they normalize it in a way. I think that if it's above 50, if the index is above 50, it shows expansion. If it's below 50, it shows contraction. Okay. But it's, first of all, one thing to realize, note, is it's a survey. So this is what they call as soft data, not the hard data. When Powell speaks or other macroeconomists talk about, well, the soft data is soft, but hard data is still very strong, etc. So that's what they're referring to. But if, for example, and then I think the level, if I'm not mistaken, I think the level shows how prevalent the sentiment is. Okay, so if it's like 51 versus 60, I don't think it means that it's the expansion speed is higher. It just means that more people have answered in that regard. So that's a bit of a nuance that I think is important as well. But anyway, so they have subcomponents. All these surveys are subcomponents. So there's new orders, there's current conditions, expectations, employment, and a bunch of other subcomponents. So usually people just look at the headline number, and then they maybe look at the new orders one, and that's it, right? Sometimes, depending on the kind of the worry of the day, they might look into employment ones. So we have new orders lower. This is April. But the other thing about these surveys is that they come out the first. So this is April data, right? Like tomorrow's report is going to be for April, but we've already had S&P Global. We already had ISM survey data for the last 2 weeks or so, manufacturing and services. So they lead in data. So that's, I think, important too. And they've been showing consistently, especially for manufacturing, they've been showing contraction for a number of years now, because obviously manufacturing of cars and homes and everything, they are very cyclically sensitive industries. So when rates rise, they're the first ones to fall. So services may wait a little bit more, right? If a boomer has $1 million saved, they paid off their house, their mortgage payment doesn't change. They might actually benefit from higher rates in terms of higher fixed income. Then they're not going to be canceling their cruises. So services may be delayed a little bit. Now, in the last couple of months, we're also seeing services numbers come down a little bit too on these surveys. But anyway, did you have a question?
No, so I mean, I just, in big picture, you're saying these surveys are saying, bless you.
I didn't sneeze.
You didn't?
No. Did I breathe?
Then I don't bless you. Go to hell. Yeah, I mean, you're saying
when people say bless you, they don't mean I bless you, you egocentric Californian.
Listen, I'm from Ohio originally, but the prices you're saying.
Oh my God.
Prices, people think the survey is saying prices, people are thinking prices are going up for these.
Yeah. No, prices paid
are going up.
So this would be PPIs.
Right.
Right.
But do you think there's like going to be latency lag between what people are actually paying and like recessionary trends. Like I don't necessarily think that those will be in sync. Like prices aren't going to go down until people have like realized they can't spend as much money, and maybe
Mhm.
take a few months for that to happen. So like I would
Mhm.
imagine
Mhm.
the poop will hit the fan in 3 to 6 months from now if everything else stayed the same.
Now define poop hitting the fan.
Uh, contraction in I guess I know GDP was down, it was negative, which
Mhm.
is
Mhm.
I can't just say
Retail sales were weaker than expected in March.
um, earnings contraction, let's say,
Mm. Mhm.
you know, in second half of this year, and
Mhm.
prices going down. I don't want to say deflation. Uh, in some sectors of the CPI, there'll be deflation. It's hard for me to say which ones. I'd
Mhm.
have to think through it. I'm
Okay.
just saying those are some
Well, I
heavier
think
indicators.
earnings contraction is a big call. Earnings contraction, what's the word again? Earnings contraction in the second half is a big fall because that's a out of consensus call. I think
Well, I
that's out of
think that
consensus call.
that is down the line, right? I mean, you can see in tech companies right now. I mean, they have good earnings, at least some of them, and they are maybe depending on the type of company a second order effect. Someone like Apple, you might start seeing earnings contraction earlier, or Amazon, right? And someone like I don't know Google, who isn't like doesn't have too much directly with the consumer, is more um, other companies paying them right for ads. I don't know if that which one's going to happen first, right? Because it could be. I was going to say, well, those would happen later. Google could have worse earnings and take longer, but at the same time, the companies who pay Google might see things earlier and say, we're going to slow down. But I just think some of those things are going to show up in like 6 months from now. I don't think consumers yet have really felt the brunt of uh, layoffs or recession or tariffs. And I don't.
Mhm.
You can argue about all those different ones. You've paid much more attention to me. I just keep thinking about the tariff aspect, and just from the tariffs alone, any increase in prices for consumer goods is going to be passed along. Yeah, they're going to try to pass along to the consumer. That's going to result in less sales, lower revenues, or lower profit, and that'll show up probably in Q3, Q4. I don't even know I don't think in Q2 because they just instituted these, right? And so I don't know. That's like my thinking, but I haven't thought that much about it.
Mhm. Yeah, let me think about that. I don't know if I expect earnings contraction in the second half, but we'll see. I mean, Tesla's a different story, right? Tesla's already kind of like turning negative and everything, but
Well, give me an
overall,
example.
these companies like Microsoft did really well.
Yeah.
Google is doing well, and those are the major drivers of the economy today.
Well, let's take Apple for an example. I don't know how localized their production is. I'm sure they moved a lot to India and Vietnam or something. But iPhones sold in the U.S. Are some of that materials coming from China? Is that correct or no?
Hmm.
Some of it. And uh, right now, these tariffs, there's a pause with most countries, but not China, right?
Hmm.
And have they bypassed for smartphones? Or are they accruing tariffs right now for Apple?
I think they get an exemption.
They got an exemption.
Hmm.
So that's the hard thing to model. Like if everyone has an exemption, then yeah, it doesn't matter. I don't know who has an exemption, who doesn't.
Hmm.
But obviously, yeah.
U.S. weighs easing Nvidia chip curves on UAE as Trump plans visit. Um, Jim Chanos had a interesting insight today that we've been talking about for a couple of weeks in TSLA, but you haven't been here, so maybe this is the first time you've seen it. So let me pin this up here. Actually, if you just go onto his profile, real Jim Chanos, right? He talks about Meta is currently depreciating its capital base over 11 years. And over the past year, their capital base has increased by 39 billion, yet their DNA increased on a 2.1 annualized rate. That's over 18 years of life on the margin. I think that's a major risk for these companies. And that's a little surprising that Meta was so positive on GPUs and everything, despite that risk. I think there's a big risk to earnings quality risk that he calls out on. And I agree with that. I've been talking about the same thing in the last couple of weeks here. These Mac 7 companies might have a bit of a earnings quality questions coming up soon, in terms of depreciation. I mean, yeah, I have to think about the earnings contraction call you just made. That's a very, very big call, Machine. I'm really impressed. Very impressed you're making big calls in my space.
There's literally no one else here making any calls, so
Hmm.
it's being highlighted.
Hmm.
I mean, obviously, could be wrong, and it totally depends on the extent of tariffs. And obviously, the tariffs. There's so many exemptions now and delays. The 90-day delay, which that start like 2 weeks ago. So you basically it's going to run into Q3. Yes, the beginning of Q3. So that wouldn't even show up until Q4 probably earnings at that point. So it might be a
Hmm.
while. And that's if things continue, right? And who knows if they will. So yeah, I could be wrong. If there ends up being no real tariffs like that, they'll still have some effect. People might supply of
Well, the
items.
interesting thing is there's going to be some tariffs. There's going to be some tariffs. I don't think he's going to raise, hundreds of billions or $1 trillion that he was expecting. I think it's going to be more around like 100 to $200 billion extra revenue, I guess, for the U.S. But the question is then, how is he going to extend his tax cuts, having not achieved much on the tariff front? Like we just learned, White House called China after saying we're not going to call China. They need to call us. And he's already walking back. He's given a lot of exemptions to companies. China has done a couple of those as well. And so he's not going to raise much revenue. On the other hand, you have unemployment, the employment market weakening too. So your tax revenue could have a bit of a problem there as well. So in the second half of this year, how is he going to deliver on tax cuts? And if he can't, if he pushes to deliver on tax cuts, what I think is going to happen is that the bond market is going to like that. The bond market is going to like that. And I think that could be a real problem.
You said the bond market is or isn't?
Is not going to like that.
Yeah.
Because if you can't raise revenue to the extent that you thought you would, you told us you would, and on top of that, you're also trying to increase your spending, how would the bond market react? So I think that's why we're seeing these long end of the curve surging today. Double-digit basis points, despite we're seeing a rise in initial weekly claims and a further weakening of the employment market. This is going to be the most disastrous year one of any administration, I think. Most disaster in terms of market, in terms of budget, in terms of geopolitics, it's going to be the most disastrous year one of any administration in history. And that's why I predicted in January, after I heard what Trump was saying, I predicted that he wouldn't finish his 4-year term. What do you think about that?
I don't know. Like, what do you think? That's only going to happen if he gets impeached. What is he going to get impeached for? Broken promises?
They'll find they'll find something.
You mocked me before by saying like, no one knows, I don't know. Now you're coming in here and Trump's going to get kicked out of office because reasons.
No, here we go. I pinned it up. Trump's term ends before 2029. So it's supposed to end January 2029. And I think it'll end before 2029. Two people already took that bet, so don't try to take it. But they'll find a reason. They'll find it. If there's a will, there's a way.
I think if he doesn't die, then I think he'll play out his term. I think this is going to be a shit show, but
he's already lost a lot of sports. He's lost the sport of, like, a lot of times people say, "Oh, he's very strong with his base." Well, his base isn't the entire country, right? His base isn't even in majority. It's really all about the independence. And both Elon and Tesla have kind of lost the support of the people in between. And if that continues, that's normal for a new administration, right? So in year one, they try to kind of accomplish the most, either right wing or left wing stuff, and then they try to kind of get to the middle again with by the midterms. But the approval rating has never dropped this fast, I don't think, and he hasn't accomplished anything still. Even with that, he hasn't accomplished anything. So he burnt all his
I just find it impressive that you've talked about his his approval report. Excuse me. Oh my God, my brain's not working. His approval rating going down, but Elon Musk's was even worse. So it's like that's saying something.
Yeah. What do you think about the news that the board was looking to hire a new CEO?
Well, I'm sure of course they refute it, and I'm sure.
Of course they're going to. What else are they going to?
Yeah, I'm sure it's incorrect in some ways, but there can be some truth to it in some way, just like there was some truth with the Model 2.
Right.
Where people, oh no, that was wrong Reuters report. Well, they're not making a Model 2 for
right
for consumers.
Yeah.
So there's probably something there. Is it he's going to step down, or is it they're going to hire a COO like Gwen Shotwell or something, who basically does operate the day-to-day, and he would still be CEO in name, but functionally not.
It's not going to make a difference. It's not going to make a difference. Right? That's not going to make a difference to Tesla, to Elon. You can hire a chairman above him. You can hire a CEO below him. He's still going to control the company, and effectively, he's still going to be the face of the company. That's not going to change anything. So if you want change, you have to take drastic action. And I'm not arguing that he should be fired or whatever, but what I'm trying to say is that today Tesla is Elon. So his approval rating means Tesla's approval rating. This is apparent as day to those paying attention, even as early as 2023, as things are going down. And some of the leading folks in this space noticed it in 2022. I didn't see it in 2022. But yeah.
I saw it in 2021. Peak.
Yeah.
I just made some stupid bets afterwards, but
yeah. Live and learn. Live and learn. I can't make mistakes, unlike you, because you're much older than I am.
I have more hair than you, though.
Yeah. Okay. Yeah. Would you trade age for years for hair?
I wouldn't trade our age difference.
That's an easy question, Machine. Of course you would. You can always get plugs like Elon.
What I was thinking was interesting is, as I get older and your different injuries start bugging you more, and I was thinking some, like, how much if I think people can live with high quality lives no matter what situation there is, right? It's all about mentality. And so if you get pushed into a different situation, like you had a severe injury or something, like you could still be happy. But I was thinking, I'm like, Man, if I got like in a car accident and I was a paraplegic, like if someone offered me, how much money would someone have to offer me to say, yes, I would prefer to have $1 billion and be a paraplegic, or not have $1 billion and be as I am today? Like, how much money would it take for me to choose that? And I don't think I could choose it. Even though if I
Mhm.
was, I would be, I'd learn to be happy.
Mhm.
I find that interesting. So like for your hair, would I choose, how much money would you have to offer me to be
To
bald,
shave your head.
like you?
Mhm.
Sad amounts of hair on the
I love,
sides,
I love
big
saddest.
beard, trying to make up for it. How much money would I have someone have to give me to choose that path? And I think it would have to be. It would. I mean, $1 million is not enough. That's for sure, right? That's nothing. Like 10 million, maybe. Yeah, I'm serious. 50 million. I'd be like, okay, 50 million. Whatever. Like I can figure it out. 10 million, I think, is like 5 to 10 million. I'm it's like threshold. Like I'm probably gonna do it. Like, but
Mhm.
5, I don't know. I don't know if I'm gonna do 5. So I think it's somewhere around 10 million.
Okay. Okay, cool.
How much would you pay for my hair? To have my hair?
I mean, I think the going rate is a few $1,000, so I guess I would pay that.
Not talking about what are you talking about? For plugs?
Plugs. Yeah, in Turkey, you can get it for a few $1,000.
Turkeys, why would I know all the plastic surgeries going on in Turkey, but I wouldn't trust going there.
Mm. Uh,
I gotta
Turkey's
go.
great. They're doing great. They're
I
doing
gotta go.
great.
Later.
Okay. All right, dude. Well, on that note, we're gonna end the space. Thank you very much, everybody. I'll chat with you all next time. Take care.